Let me describe a situation to you and tell me if this sounds familiar. You've been working full-time for 5 years. Maybe longer. You've been saving money. You've been responsible with your finances. You make decent money, $60,000. You finally feel ready to buy a house. You start looking at listings in your area. Houses that your parents bought for $180,000 in 2005 are now listed at $650,000. Houses that look like they should cost $250,000 are somehow $800,000. You think, okay, maybe I need to look at condos or townhouses. Those are $400,000 to $500,000. You run the numbers with a mortgage calculator. Even with 20% down, which would take you another 3 years to save, your monthly payment would be $4,200. That's more than half your take-home pay. The bank pre-approves you, but tells you that you'd be house poor. You'd have no money left for anything else. So you keep renting, paying $2,200 a month for an apartment you'll never own, watching home prices climb another 8% this year, another 12% next year, feeling like you're falling further behind every single month. And everyone tells you the same useless advice. Just save more. Move to a cheaper city. Buy a fixer-upper. Wait for the market to crash. But here's what nobody is telling you. The reason you can't afford a house isn't because you're not saving enough. It's not because you're bad with money. It's not even because houses are expensive. The reason you can't afford a house is because you're not competing with other families anymore. You're competing with Wall Street. You're competing with billion-dollar investment firms that can pay cash, close in 7 days, and outbid you by 20% without blinking. The game changed. Nobody told you, and you've already lost before you even made an offer. My name is Mike, and in this video, I'm going to show you exactly what happened to the housing market, why it's not going back to normal, and what you can actually do about it if you want to own property in the next 5 years. If you're someone who's been trying to buy a house and feeling like it's impossible, or if you're watching home prices climb while your salary stays flat and you want to understand what's really happening, hit that subscribe button and give this video a thumbs up. Here's the thing. When you were growing up, your parents bought a house by competing with other families. There were 4 or 5 families bidding on the same house. Whoever had the best offer, the most stable job, the best down payment, got the house. It was a fair fight. You were competing with people in your same economic situation. That world is gone. It doesn't exist anymore. And the change happened so fast that most people don't even realize the game is completely different now. Let me give you the numbers because this is important. In 2010, individual families and people buying homes to live in them made up about 89% of all home purchases. Investors buying homes as rentals or investments made up about 11%. That's normal. That's how it had been for decades. By 2020, that number shifted. Investors were buying about 18% of homes. That's nearly double, but here's where it gets insane. In 2021 and 2022, during the post-pandemic buying frenzy, investors bought nearly 28% of all single-family homes sold in America. 28%. That means for every 4 houses sold, one of them went to an investor, not a family. But it's actually worse than that because those numbers are national averages in some cities and some neighborhoods. Investors bought 40%, 50%, even 60% of available homes. You weren't competing with 3 other families. You were competing with 3 other families and 6 investment companies. And when I say investment companies, I'm not talking about some guy buying a duplex to rent out. I'm talking about massive institutions. BlackRock, Invitation Homes, Pretium Partners, Progress Residential. These are companies managing tens of billions of dollars. Companies that exist for one reason: to buy single-family homes and rent them back to you forever. Let me explain how they operate because once you understand this, you'll realize why you can't win. When you make an offer on a house, you make an offer based on what you can afford. You're getting a mortgage, so the bank looks at your income, your debt, your credit score, and tells you the maximum you can borrow. Let's say you're approved for a $400,000 mortgage. You find a house listed at $380,000. Perfect, you make an offer at asking price. $380,000, maybe even $390,000 to be competitive. You're excited, you're nervous, you're hoping. Then you get a call from your real estate agent. Bad news, we got outbid. Another offer came in at $455,000, all cash, no inspection. 7-day close. You just got beat by an investment firm. And here's the thing, that house wasn't worth $455,000. The company didn't pay $455,000 because that's what the house is worth. They paid $455,000 because their algorithm told them that in that specific zip code, they can rent that house for $2,800 a month. At $2,800 a month, they'll make their money back in 14 years. And then they own the asset forever. They're not buying a home. They're buying a perpetual income stream. And they have billions of dollars to do this at scale. You're trying to buy one house to live in. They're buying 2,000 houses this quarter to rent out. Here's where it gets even worse. These companies aren't just buying houses randomly. They're using data and algorithms to target the exact neighborhoods where prices are about to rise. They have teams of data scientists analyzing migration patterns, job growth, new development, school ratings, crime statistics, rental demand. They know which neighborhoods are going to appreciate before you do. And once they identify a target neighborhood, they buy everything. I'm not exaggerating. There are neighborhoods in Phoenix, in Charlotte, in Atlanta, in Jacksonville, where a single investment company owns 30%, 40%, 50% of the houses on the street. They turned entire neighborhoods into corporate-owned rental communities. The families who wanted to buy in those neighborhoods and build equity got priced out. Now they rent from BlackRock for $2,400 a month, paying off someone else's mortgage, building someone else's wealth. And here's the part that should make you furious. These investment companies are getting better financing than you. You're going to the bank and getting a 7% or 8% mortgage rate. They're going to Wall Street and issuing bonds at 3% or 4%. You're putting down 10% or 20% because that's all you can save. They're paying all cash and then refinancing later at institutional rates. You're paying closing costs, inspection costs, appraisal fees. They're buying in bulk and negotiating all of that away. The system is designed for them to win and for you to lose. It's not a fair fight, it never was. But nobody told you that. Everyone still pretends like you're competing with other families when the reality is you're getting steamrolled by institutional capital. Now you might be thinking, okay, Mike, but why? Why are these companies buying houses? What changed? Great question. And the answer is going to make you understand why this isn't going back to normal. After the 2008 financial crisis, the Federal Reserve dropped interest rates to nearly zero. They did this to stimulate the economy, to make borrowing cheap so businesses would invest and grow. That worked for businesses, but it created a huge problem for investors. If you're a pension fund, a hedge fund, an investment firm, and you have billions of dollars to invest, where do you put it? Stocks? Bonds? Paying 1% or 2%, that's not enough. The stock market is volatile, real estate. It is stable, tangible, and has consistent returns. So institutional investors started looking at residential real estate as an asset class. They realized, wait, we can buy houses, rent them out, and get 6% to 8% annual returns plus appreciation. That's way better than bonds. And that's exactly what they did. Blackstone, the largest private equity firm in the world, created a company called Invitation Homes specifically to buy single-family homes. In 2012 and 2013, Invitation Homes spent $10 billion buying over 50,000 houses. Other firms saw this and said, oh, that's genius, and copied the model. Now there are dozens of these companies, and they're all still buying. In fact, they're accelerating during the pandemic. When housing prices were climbing and regular people were struggling, these companies were buying more than ever. Why? Because they're not worried about paying too much? They're not trying to flip houses. They're building rental empires. They plan to own these houses for 30, 40, 50 years. They don't care if they overpay by 10% or 15% today because in 20 years, the house will have doubled in value and they'll have collected hundreds of thousands in rent. They're playing an infinite game. And you're trying to play a finite game you can't win. So let's talk about what this means for you. Because I'm not just here to tell you bad news. I'm here to tell you the truth so you can make informed decisions. First truth. Home prices are not going back to normal. The normal that your parents experienced where a middle-class single income could buy a house. That's over. It's not coming back. Why? Because as long as investment firms see residential real estate as a high-return asset class, they will keep buying. As long as they keep buying, they will keep driving prices up. As long as prices go up, regular people get priced out. It's a feedback loop, and there's no incentive for it to stop. Second truth. Waiting for a crash is probably not going to work. Everyone keeps saying, just wait for the housing market to crash like 2008. Here's the problem. The 2008 crash happened because banks were giving mortgages to people who couldn't afford them. Subprime loans, no documentation, it was a house of cards today. Lending standards are much stricter. Most people who own homes can actually afford them, and more importantly, institutional investors buying with cash can't default. They're not over-leveraged, they have billions in capital. Even if there's a recession and prices drop 15% or 20%. These companies will just buy more. They'll see it as a discount. You're waiting for a crash so you can afford to buy. They're waiting for a crash so they can buy cheaper. You still lose. Third truth. Your competition isn't going away. It's growing. More investment firms are entering the single-family rental market every year. There are now publicly traded companies whose entire business model is buying houses and renting them. They have shareholders expecting growth. That means they have to keep buying. This isn't a temporary trend. This is the new structure of the housing market. Now here's what you actually can do. Because I'm not going to leave you without options. Option 1. Stop competing in the same market. If you're trying to buy a move-in-ready single-family home in a desirable neighborhood, you're competing directly with institutional investors. And you're going to lose. Instead, look for properties they don't want. That are easy to rent immediately. They don't want fixer-uppers. They don't want properties that need major work. They don't want weird layouts or properties in less predictable areas. If you're willing to buy something that needs work, something ugly, something that requires renovation, you can get it cheaper and you won't be competing with BlackRock, yet it's more work. But it's one of the few ways to actually get into the market without getting steamrolled. Option 2. Look in secondary or tertiary markets. Investment firms are targeting Tier 1 cities and high-growth metros. If you're trying to buy in Austin, Phoenix, Charlotte, Nashville, Miami, forget it. Those markets are flooded with institutional money, but smaller cities, less trendy areas, places that are on the top 10 cities to move to lists. Those still have opportunities. You might not want to live there. But if your goal is to own property and build equity, sometimes you have to go where the opportunity is, not where it's trendy. Option 3. Consider alternative ownership models. This might sound weird, but hear me out. Co-ownership, fractional ownership, land and build. These models are growing because traditional home ownership is getting locked out for so many people. Some people are buying land in cheaper areas and putting a manufactured or modular home on it. They own it outright, no bidding war. Some people are going in with family or friends and co-buying a property. Splitting ownership, it's not traditional, but traditional doesn't work anymore. Option 4. If you can't buy, optimize your renting. This is going to be controversial, but I have to say it. If you can't afford to buy in the next 3 to 5 years without destroying your finances, don't force it. There's this huge pressure to buy a house because renting is throwing money away. But you know what's worse than renting? Buying a house you can't afford. Being house poor. Having no emergency fund. No ability to invest, no flexibility, and then losing the house in a downturn. If you're going to rent cheap, way below your means. And take the difference between what you're paying and what a mortgage would cost and invest it aggressively. Real estate isn't the only way to build wealth. If you're paying $1,800 a month in rent and a mortgage would cost you $3,500, invest that $1,700 difference. In 10 years, invested at 8% average returns. That's over $300,000. That's equity, just in a different form. Option 5, buy real estate differently. If you can't afford to buy a home to live in, buy a property to rent out. I know that sounds backwards, but hear me out. In some markets, you can buy a small condo, a duplex, a small rental property in a cheaper area for $100,000 to $180,000. You rent it out. The tenant pays the mortgage. You build equity, you keep renting where you live cheaply. But you own an asset that's appreciating and generating income in 5 years. You can leverage that equity to buy a bigger property or even the home you want to live in. You're using the same strategy the institutions are using. Buy properties that generate income. Not just properties to live in. Here's what I want you to understand. The housing market is not broken. It's rigged. It's rigged in people with massive capital. It's rigged in favor of institutions that can outbid you without even blinking. And it's not going to unrig itself. No politician is going to fix this. Why? Because institutional investment in real estate is seen as good for the economy. It stabilizes prices, provides rental inventory, creates jobs. The fact that it prices out an entire generation of middle-class families is considered an unfortunate side effect. Not the main problem, so waiting for someone to save you is a waste of time. The only way forward is to understand the game that's actually being played and find a way to play it differently. Stop trying to compete with Wall Street on their terms. Find the gaps, the opportunities they're not taking, the strategies they're not using. Buy the ugly house, buy in the boring city. Buy the property nobody wants and turn it into something. Co-buy with other people, buy land, buy a rental property instead of a primary residence. These aren't the traditional paths. But the traditional path is closed, the bridge is out. You can either stand there complaining that the bridge is out, or you can find another way across. I'm not saying it's fair, I'm not saying it's easy. I'm saying it's reality, and once you accept reality, you can actually start making moves instead of just feeling defeated. One last thing I want to address because I know people are going to say this in the comments. Mike, you're being too negative, the market will correct. It always does, and look, maybe there will be some correction. But here's what you need to understand. Even if home prices drop 20%, which would be a massive correction, we're still way above where we were 5 years ago. That's still unaffordable for most people, and during that drop, institutional investors will be buying more, not less. They have cash reserves specifically for moments like that, so yes, maybe there's a correction. But it's not going to magically make housing affordable again. The structural problem, the fact that Wall Street is treating your neighborhood like a stock portfolio, that's not going away, so plan accordingly. Don't wait for a miracle. Don't wait for a crash. Don't wait for prices to go back to 2015 levels. It's not happening. Make decisions based on the market that exists, not the market you wish existed. If this video helped you understand what's actually happening in the housing market, smash that like button and subscribe for more content that tells you the truth instead of selling you hopium. The system is rigged, but that doesn't mean you're powerless. It just means you need to play a different game. See you in the next video.